I'm Darius McDermott from FundCalibre, and this is the latest edition of the Investing on the Go podcast. I'm delighted to be joined by Hugh Sergeant, the elite rated manager of the R&M UK Recovery Fund. Hugh, how are you?
Yeah, very good. Thank you, Darius.
Good. So I know the last time we did a podcast together, we looked at performance and, in spite of the fact that growth having dominated value styles in the market, your fund now outperforms over 1, 3, 5 and 10 years, and by quite a long way, by over 100%. How have you managed to do this with a value-oriented strategy in a growth market?
Thanks for that very positive question, Darius. Obviously, it's good to have been able to generate strong returns over the last few years, especially as you suggested in the context of quite a headwind against our core investment philosophy, the value component in particular. I'd split it down into, a number of things that have supported us. I mean, the first is in investment, you need a bit of luck. So we've had some lucky stock picks as well as some very, very well thought out stock picks. I think our definition of the value philosophy is a broader one than some, of our value peers, some of the, traditional, more deeper values. So our philosophy is potential valuation and timing. So we're looking at complementary factors either alongside value. So potential is just looking for companies and grow their shareholder value at above average pace. And then we also think about the timing aspect, and we look at share price technicals and earnings revisions, and we want those to bottom out before putting decent amount of capital to work. So I think having that kind of broader definition of value has definitely helped. We've had a consistent multi-cap approach. So by that I mean, as well as looking at large cap companies, we've been investing in mid and smalls, and I think the mid and smalls component has definitely been more supportive than value stock picking at the larger cap, and so that's helped. I think we're typically pretty gradualist into positions, so we build up positions really quite slowly. It's one reason why we've got higher stock count than I suppose most investors. But we're gradualist, and we look for positive fundamentals to start coming through. So when it's a recovery stock, you want a company to start delivering that recovery before you get too excited. So being pretty gradualist. And I think we've got some aspects of the big picture right. So we didn't go too aggressive immediately after the referendum, the Brexit referendum. I think again some of the peers might have been more aggressive into domestic value stocks, and we just held back a little bit. So I think that was a good big picture decision, and we went pretty aggressive during the peak of COVID 18 months ago, when clearly there were lots of very distressed investors and investments out there. So we went quite aggressive there when there were particularly strong opportunities at that point, and I think that stood us in good stead for the recovery since then. So it's a kind of multi-dimensional answer, but yeah.
Now, one of the things, and you've already touched on it there, was the number of stocks that you hold in the portfolio, which is extraordinarily unusual in the asset managers that we talk to, over 300 in fact. I mean, clearly there's a lot of diversification benefits there, but do you feel sometimes maybe it's over diversified? And how do you possibly keep on top of 300 stocks at any one time?
Yeah, I mean, it's obviously been an observation. I think in terms of the funds that I manage over quite a few years, I've typically been more diversified, i.e. a larger number of holdings. I mean, in the early stage of my career, I remember one or two, large positions that went wrong, and that created quite a high degree of angst. So I think since then, I've always said, well, actually, the value and recovery is an approach that probably lends itself to being more gradualist and being more diversified rather than being really concentrated. I think if you're running quality or franchise leaders or whatever, then you can probably stick to a very concentrated approach. I think with value and recovery, it lends itself to being more diversified. So that's always probably been my approach. And I don't think it's held back returns. For example, the returns that you mentioned in the first question have been delivered with a relatively larger number of individual stocks. I think the gradualism is a particularly supportive part of the approach. Getting exposure relatively slowly, waiting for the fundamentals to come through. Things like Marks and Spencers, for example, it's starting to beat expectations before you put a decent amount of capital into that. So it was starting to beat expectations a few quarters ago, and then we became more aggressive. So in terms of the actual physical coverage, all I'd say to that is that we have invested in the team here. So we started off with 4 of us right at the beginning 15 years ago, and there's now 13 in the team. So we've invested in the team, invested in analysts, and then we also have this very important quants front end, so quantitative. So we use the power of computers to help us do our job, screening the universe for new ideas, and also monitoring existing portfolios. So it's a combination of investing in the head count, using quants, and also, I suppose, my experience, which is over 30 years. So most companies I've come across at some point during my 30-year career.
Well, is it extraordinary, especially as I'm aware that you also run a global fund, and that attention to detail across so many stocks is quite exceptional. So let's just drill down then into the last year. It's almost plus or minus, I think, a day since the vaccine bounce. That the announcement of the vaccine efficacy from Pfizer, and we saw a substantial bounce in the value areas of the stock market. I think it's been captured, the reopening trade, or whatever you want to call it. But it's been a very strong year for the fund. What's your sort of outlook on the reopening, or are we fully open and not going back? How do you see that playing out?
Yeah, I mean, we're relatively, comfortable and optimistic about, the outlook from here. I mean, UK equities have been strong, and obviously within that, the value and recovery trade has been robust. But actually, UK equities in terms of the valuations today are still really quite modest. UK equities have actually been derated over the last year. So if you actually look at share price returns relative to profits growth or earnings growth, actually there's been a derating. The UK market's earnings multiple for next year is sort of 12 and a half times, a relatively modest valuation. And then the recovery strategies trading at a similarly modest valuation from an earnings perspective. The price to book is only 1.4 times, price to sales only 1 time. So the valuation metrics are supportive. I mean, value had a relatively strong bounce immediately post the vaccine news, but actually the last couple of quarters, last 6 months, value's retraced quite a lot of its outperformance. So we actually describing it as an opportunity to go again. And actually quite a few of the, theoretical reopening beneficiaries have been relative laggards over the last couple of quarters. Perhaps they got a little bit overexcited at the beginning of the year. There have been some short-term worries for the market, cost price increases, taking money out of the consumer's pocket, things like that, which has created sort of a sentiment headwind. So actually we think, the reopening stocks are actually, should be really well positioned over the next year, because sentiment's actually relatively low at the moment, and we'll pick up valuations to support it. Good example would be something like a restaurant group, that runs the Wagamama chain. The shares are down 30 or 40% over the last 2 to 3 months, and has retraced much of its relative outperformance post the vaccine news. So if you look at the airline stocks, IAG or British Airways, for example, it's hardly recovered at all. Despite the really positive news about the transatlantic routes now reopening up. So I think really pretty positive.
Yeah. Another thing that we've noticed, because this is a UK fund and all funds are allowed to have a portion of their up to 20% outside of their home geographies, but I noticed you've recently invested in China via two positions, the Fidelity China Special Situations Investment Trust and a holding in Baidu. I'm guessing the sell-off has probably led you into that and better valuations, or what specifically do you like about those?
Yeah, let me take you through that, Darius. I mean, we've always, within the UK recovery strategy, you used up the opportunity to invest up to 20% outside of the UK. So we've consistently run between, I suppose, 15 and 18% of the strategy in non-UK stocks. Actually, when we launched the fund back in 2008-9, our focus then was on US recovery opportunities. Obviously, the US has been a particularly strong market, and now one of the most interesting areas from our perspective is China. I mean, clearly, there are risks associated, significant risks associated with China, but the market's very, very aware of them, and great opportunities never come without a background of risk. And we would describe, China as a significant opportunity. Today, it's only 4% of the MSCI world benchmark, when it's the second largest economy in the world on a PPP basis, actually now the largest economy in the world. So I think it's underrepresented. I don't think we've got time to go into all the kind of regulatory issues that have led to the digital stocks coming back aggressively, but we just think it's now fully discounted in share prices. So there's an opportunity to buy those sorts of companies on single-digit earnings multiples. If you strip out the cash and other equities that they're holding, so single-digit earnings multiples for some of the best businesses in the world. I mean, it's like being given the opportunity to, I suppose, invest in Amazon or Microsoft on a single digit earnings multiple. Most people, if you've mentioned that, would grab the chance of doing that. There are obviously much higher valuations of that today. So there is a opportunity, and Baidu is one of those. I've actually described it as the cheapest mega cap stock I've ever seen in my investing career. Again, probably haven't got the time to go through that, but if you strip out the cash and equities, equity holdings it has, it's valued on about 10 times the free cash flow from its core search engine. But that's not what Baidu is, just about these days. It's got the leading AI business in China, artificial intelligence business in China. Yeah. It's got the largest, but the leading autonomous vehicles, so driverless vehicles franchise, and it's got the number 3 cloud business in China. Then on the investment, so those are all in for free. And then on the investment trust side of things, we know we're comfortable investing 2 to 3% of the fund in investment trusts, and we typically look for regions or parts of the investable universe that are temporarily out of favour, and you can buy them at a discount, I guess, and then buy them at a discount. So we think the Fidelity China very much fits that at the moment. So a good track record over the years, and available on a discount at the moment. So hence its inclusion in the portfolio.
Now, I know slightly earlier in the podcast we did touch on the outlook for the UK with the reopening trade and everything that's gone on with the pandemic. And the UK has been quite unloved, let's be honest. And you pointed to the derating. Are you optimistic? Maybe it's the last region with some valuation support left in the globe, or do you? Is it just at a company level those valuations which are maybe keeping you smiling?
Yeah, I mean, it is interesting. I mean, I do run a global recovery strategy as well. I mean, and the interesting point, one of my key observations at the moment is that in a pretty expensive or very expensive world, it's actually very easy to find, really good value around the world. And typically it's in markets that for whatever reason are out of favor, or maybe they have more value exposure rather than growth. I mean, there's a really high correlation between equity markets around the world, and if they're perceived as, giving you strong exposure to, the kind of classical growth stocks, then they're on pretty full valuations like US equities.
Yeah.
If they're regions around the world that have had short-term issues or aren't giving you that much exposure to that kind of growth and momentum trade, they're on low valuations. So there is that opportunity, and UK equities, classically fits the bill of unloved post Brexit, and not necessarily giving you the exposure to the strongest growth sectors of the last 5 or 10 years. So as a result of that, UK equities do trade on a really modest valuations at the moment. Actually, if you look at the relative valuation of UK equities versus global equities, US in particular, we're basically where we were back in the mid 70s during the 3-day working week, etc. So very out of favor. 12 times earnings multiple. I mean, that's, a relatively attractive absolute valuation. So then we think the outlook for the UK economy is perhaps more robust than commentators are suggesting. We think in particular the consumer in the UK has been a little bit written off because of, short-term cost increases. I mentioned earlier, there's this worry that this is, taking away spending power from the UK consumer, costs and tax rises. But we think that's overwhelmed by some of the positives. The positives being, if you look at the savings ratio, it's remained really high in the UK over the last 2 years, even into, as we speak, it's remained high. So there's a big pent up potential for consumer spending. Unemployment's remained relatively low, and as we know in lots of parts of the economy, there's pretty full employment at the moment. That means that consumers are pretty confident about the outlook. They're getting higher wage increases. Wage inflation is running higher in the short term. That's positive for consumer confidence. And then there's the wealth effect of house prices and equity prices going up again, creating kind of high degree of consumer confidence. So we're particularly positive about the outlook for the consumer versus currently very depressed expectations. Yeah, and we think that will support a big part of the UK equity market over the next 18 months.
Thank you very much for that. So look, we always like to try and drag one stock out and maybe just finish on that. What's been the best stock in the portfolio this year, and why has it done so well?
And we've had one or two winners, but I might just mention Somero, I think, just because we've had a decent position in the portfolio, and it has generated really strong returns over the last year. So it's gone up, I think, around 150%. Right. So Somero has a dominant global market position in quite a specific product area, which is big pieces of kit that go into leveling concrete. That's been kind of critical, I think, in particular for the big warehouses that are going up in the US and around the world to fulfill e-commerce, etc. Now, 18 months ago, during the COVID downturn, obviously investors really worried about the economic downturn, and in particular for Somero, the cyclical downturn in construction spending. So the shares got pretty hit, and they did see a few quarters of demand falling. So it was a difficult short-term background, equaling an opportunity to quite significantly add to our position as we went through last year. Since last year, trading has picked up pretty robustly. So there's been a cyclical recovery, and then there's this structural element, which is seeing strong demand for their kit and strong investment in big warehouses in particular. So it's a combination of cyclical recovery coming through and strong underlying structural demand set against a relatively modest valuation, which has allowed the share price to progress. But we still see it as very interesting, actually, because there's a fear that current cyclical demand is as good as it's going to get, and therefore the shares have kind of been capped at the current level. But actually, we think there is a strong case to be made for continued structural strength, and then being able to extend their sales from the US into the rest of the world. So we think actually the structural element will continue to be pretty robust over the next few years, and it's probably wrong for the market to get too worried in the short term about the cyclical element. So we continue to hold a decent exposure to some area in the portfolio.
Hugh, thank you so much for your time today, talking us through some of the interesting parts of not only your fund but the market, and discussing the sort of valuation anomalies that on UK equities and the fact that it is so unloved. Maybe investors will one day return in their droves to UK equities. But if you'd like to get some more information on the R&M UK Recovery Fund, please do visit FundCalibre.com. And if you are loving the Investing on the Go podcast, please do remember to subscribe via your normal channel. Please remember, we've been discussing individual stocks to bring investing to life for you. It is not a recommendation to buy or sell. The fund may or may not still hold these stocks at the time of listening.